Hey traders, Siam here. So I've been around this block for a number of years now. It's over 15 years now, bloody hell. And I've seen everything. I've seen, superstars, people that will never win with trading. I've seen and everything in between. And one of the key things I think a lot of people misunderstand are these three things here: expectancy, variance, and streaks. And I mean, I've always said you could give the world's best trading algorithm to a whole bunch of people, and some will make lots of money, some will make no money or lose lots of money, even with a good system. So I think this is really important, and we've got a lot of new members in the community at the moment, and I'm seeing some of them go down a rabbit hole of misunderstanding, if that makes sense. So I just wanted to address that, and it will also help massively with the bot. Okay, so these are the things we're going to cover, and the best example of this is heads and tails. So as we all know, heads and tails is 50-50, okay? Providing it's an equally weighted coin, it's 50-50. So what this means, hopefully you can all agree that if you flipped a coin, 1,000 times, 1,000,000 times, you're going to get bang on 50-50 results, okay? Pretty close. And so the net outcome of that is 0, okay? So it's no more heads, no more tails. So that's basically a zero expectancy system, okay? So that means if you were to bet £1 for heads, and then flipped it, 1,000,000 times, you'll end up with 50%. Half of that in losers and half of that in winners. So basically the net result is zero expectancy. So I'm not going to go into the equation of expectancy in this video, that's for later. But what this effectively means is if you have a zero expectancy system, it basically means for every pound that you risk, you're expected to make £0 in profit. Okay, hence 50-50. Now obviously when you start tweaking these hit rates, everything's going to change. So the moment you let's say you're betting on heads and it's 51% in your favor, all of a sudden you're now going to have something like a 0.01 0.01 expectancy, something close to that. So and the thing is, hopefully, and this is where variance comes into play, and this is what screws people's brains over. So if you had a whole bunch of people to flip a coin 10 times, you're going to have all sorts of results. You're going to have some people that get 10 heads in a row, and then conversely you're also going to get some people that get 10 tails in a row. But what you'll find is that for the tails, I think the most part is that most people are going to get something like 5 tails, and then all sorts of different things in between. And the same with the green stuff, you're going to get all sorts of stuff in between. But I guess most people out of 10 throws, they're going to get something like, that's where most people are going to hover around the 5 heads, okay? And so what I mean by variance is because your data sample is only 10, what this means is that there's lots of margin of error, so to speak. So in trading or statistics, this is called a variance in basic terms. So you have the outliers over here and the outlier over here. So this effectively means that your variance is super, super high, okay? Super high. So let's just call that variance, as in that range, let's just call it X. Now, if you were to get those same people to continue playing around or throwing those coins, and let's say it's now 100, what you'll have is I doubt it will ever happen. In fact, it's statistically improbable. You're not going to get someone that has 100 heads in a row. I mean, it's never going to happen. Not with a 50-50 outcome. And so what you'll find, and then if you keep on doing this, what you'll find is that the bigger the data sample gets, as you can see, here's 10 throws, 100,000, 10,000. This is what's going to happen. This is going to be very quickly like this. You're going to have something like that, and then basically you're going to have all of the in between, And by the way, you could get some people that go like this, that all, you know, completely oscillate, but you're going to get, in fact, let's just do it like this. Let's just look at the outliers. It's going to look something like this. And then the reds, so the tails, you're going to get something like this. Okay? And then obviously every other combination between people going like this, etc. So eventually, let's say you have 10,000 people flipping this coin 10,000 times. What is the variance now? The variance is teeny weeny. The variance is, I know, let's say it's like this big. So this, yeah. So this. Yeah, sorry, ignore that. This is going to be a lot smaller. Okay, in fact, let's just say that this is, 5x, and this is now x. So the variance is going to be much smaller. So this is why with trading, if you have a positively skewed system, i.e., something which is statistically probable, you're going to end up making money. So the variance is low. So this is why, especially playing with our bots, you need it to give it time. Now if I just take this picture, I'm going to move my ugly mug and then do something like this. Take a little picture. I can't do it in Microsoft Paint because it's limited, and I don't know how to use Photoshop. However, I'm a pro. I'm a PowerPoint pro. So watch this. Okay, so now we've got this picture, right? So with a 50% outcome system, so zero expectancy, your net result is going to be like this. However, if you had a statistically positively skewed system, it's going to be something like this, if that makes sense. Obviously, ignore the axis doesn't also tilt, but you're going to have something which tilts to the upside. In fact, I probably didn't need to do this. What I could have done, if I just get rid of all of this malarkey. Okay, so now let's just say, for example, we have a weighted coin, and it's now 60% going to land on heads, 40% on tails. And let's say you're going to be betting on heads. So you want heads. So basically, the money's in your favor, and then over time, what you're going to have is something like this. You're going to have something which, yeah. So that is pretty much what's going to happen. So yes, you can have the outliers which they go massively against you. You're going to have some outliers which go massively against you. But eventually, as you can see, the general direction is that everything is going to weigh. That's supposed to be that color. Everything is skewed to the upside, and yeah. So hopefully that explains expectancy and also variance. Now we need to look at streaks. So this is an interesting one. So let's get the Monte Carlo up. So here we go. We've got the Monte Carlo projection. You'll find this later on in the course. So let's say you start an account with 10 grand, max risk, 1%, hit rates 50-50, commission, whatever. So every time I click this, it's going to run a new Monte Carlo projection. So we start at 10 grand, so in this one, you pretty much ended up at 10 grand because it's 50-50. I mean, technically, it should be slightly to the negative because you've got commissions. But every time I press this, some will go massively down, some will go massively up. Some will just go straight down like this, and this one looks like it went straight up and then down a bit. But you're going to get all sorts of things, but you'll never see this go to like 30,000. This is always hovering around this 10,000 mark. Now, if we just move this to say a 51% hit rate, it should go up more than down, but yeah, it's still statistically pretty similar. I mean, this one's all up to 16,000. But now, let's just move this to 60%. All of a sudden, this is a winning system. So in trading, sometimes you'll go, oh my god, this is amazing. This is I can't lose. 60% hit rate. I'm making, let's say, my risk reward ratio is 1. So I'm risking £1, but I'm also making £1. It's winner. It's guaranteed winner. But a lot of people scare themselves out because they may end up something like this. If I can try and get one, there we go, like this. So if we were to zoom in all the way, whoopsie daisy. So imagine the TJ, right? We can set up the TJ so it's statistically a 60-odd% hit rate, 59-60% hit rate. Someone joins the system, and this has happened already in the community. Someone joins, sets up their bot, they put some money in their bot, and in the first month they have, they go down. So in this case, starts with 10 grand, went down straight away, had a little bit of profit, and then whoa, really down. And this is where everyone starts losing their shit and going, Siam, you sold me a dud bot, this doesn't work, I'm massive, this is a 60% hit rate, I shouldn't be down, blah blah blah. Now most times they've probably made some bot errors, like they've got several bots running or whatever, but let's say there's no errors in the bot. This is just normal statistics just playing out. And so this is why you need, so if you let time carry on, this is what you'll get. Eventually you're going to get something which ends up doing well. And even this bit here, so as you can see, we have a ranging, it looks like a bullish rectangle here, where it's ranging between 14,000 and 12,000. And so, how many, so between 100-ish, 90-odd trades and 250-odd trades, you basically have stagnation where you're losing lots, winning a bit, losing a bit, and you're just going sideways. So this is another thing that people screw themselves over, is because they go, oh, okay, this was a winning system, but for the last year, it depends on how many trades you place a year. This could be a whole year of trading. So a lot happens in your mental state over a year, because you go, oh my, this was making money, but now for the last year it's just gone sideways. Oh, it's shit. And now you start strategy hopping. You start looking for other things, something that looks sexier, and then guess what you miss out on? If you were to abandon this system, guess what? You'd miss out on the eventual, rally. So that's that. Now let's have a look over here. You can see streaks. So this is after 50 trades, 100 and 500. So with a 60% hit rate, look at this. You have a maximum of, say, 12.17, as in the probability of having 12.17 wins in a row, or 9 after 100. But look at this. Over a 500 trade block, you could have up to 6, maybe 7 trades in a row that lose. And that's going to hurt. So this is why, this is another deadly thing. A lot of people think that, okay, what I'm going to do, I'm going to have a really high hit rate system, something like 60-70%, and then I'm going to bet shitloads per trade. I'm going to go 10% max risk, etc. Well, guess what? Over a 500 trade system, like if you're betting 10% max risk per trade and you have 6 losing trades in a row, you've blown your account pretty much. Or even after 50 trades, which is nothing, you could still have 4 losers in a row. So this is why you still need, look at this. If I just put this to 10% max risk, so we know this is a profitable system, but if we zoom out a bit so we can see this chart, yeah, okay, obviously this one looks crazy. We will have systems which should lose a lot of money. Should, obviously I've gone, no, okay, that's not gonna, I think it's not showing us too much down here. So if we just bring this back down, this system, no, okay, it's not showing us. Yeah, you can't really see here, but you can see it would have gone down a bit. It's just annoying that it's skewed it this far. Yeah, it's just showing silly numbers now. But if you can zoom in, you'll see that some of these will have a bit of a losing streak. So, so let's go back to yeah. So hopefully, yeah. So losing streaks are very, very important. So this is what I mean when it comes to the bot. Ignore this. This is just a yeah. This is yeah. Ignore this. I'm testing lots of different things on this one, but some people may be in negative profit at the moment. But you just, yeah. All I'm gonna say is just remember this: the variance, expectancy, and also win rates, etc. So yeah, that's it for now, and I'll chat with you soon.